Welcome back. There is a recovery underway. The mid-cap index is up more than 2%, so things are looking strong, and we managed to hold on to that, pullback. Ajit Banerjee, Chief Investment Officer at Shriram Life Insurance, is now with us to talk markets and the way forward. Ajit, thank you very much for joining in. There is one view in the market that this slowdown that we're seeing, domestic slowdown, is going to be a little more prolonged, and therefore we're in for a period of weak earnings growth compared to at least consensus expectations. Now, you're penciling in a 9 to 10% earnings growth for FY25 and 11 to 12% CAGR over the next 3 years. Does that seem a little excessive, or do you expect domestic economy to bounce back in the subsequent quarters?
Okay. First of all, first things first, thanks for having me on the show. And
thank you for joining.
Wish you and your viewers a very happy Makar Sankranti. See, at this point of time, we have been used to seeing, a quantum leap as far as our GDP growth is concerned, and that was quite, I would say, supported by high amount of, government support in terms of capex as well as pent-up demand from the consumption side, both of which at this point of time are lagging a bit. Now, of course, the bigger question is government also is to what extent they would like to set its eye on setting the fiscal in order, what it has already taken a target, or go into a fiscally expansionary mode. That's something what we need to see. So, and at the same time, to add to that, how post January 20th, once Trump version 2 comes into power, how, the way things, he has been, giving one news and shockers to the world. So everybody is quite, I would say, skeptical about how things will unfold once he comes into power. So, lot many uncertainties are there. Some might turn out to be a tailwind for us, for the economy, and some might turn out to be a headwind as well. Now, since internally also, the urban consumption has slowed down a bit. So naturally, and at the same time, we are not, seeing a good amount of, tailwinds in terms of the cost, cost and the margin from the, entity's perspective. As a result of which, we expect that going forward, at least for next couple of years, there would be a bit of a, lower double-digit, growth, which is going to come in terms of the, earnings for next couple of years at least. That's what is our in-house view.
Okay, double-digit growth for the next couple of years is what you're highlighting. One point I want to also understand. Okay, you did highlight, Trump coming in and that uncertainty is there, but US rate hikes, that's also there. We're seeing a stronger dollar right now, as well as, trade policy, those continue to be the headwinds. So what is it that maybe could work out for the Indian equities? Possibly, what are the triggers that maybe we could see this growth going forward?
So, one thing which can benefit us, because we also have a good amount of export in terms of IT, pharma, as well as in the service sectors also we are doing pretty well. I guess if the US economy recovers at the same time, if there is a expansion happening in terms of mood looks to be pretty high at this moment. So therefore, we can expect, higher amount of order flows from the US for the, pharma in any case is doing well, as well as IT. And also India can also benefit from, if the curbs what are being and the tariffs which are being threatened at this point of time, and I'm using the word threatened because we need to see that what comes out finally, if on China and Mexico, Canada comes in. So as an alternate sourcing, partner, India might actually be benefited out of it. So so far we have seen that with the earlier dispensation of Trump, as well as Indian government was pretty good. So if India can further cement the ties as well as, then we can benefit out of it. So at this point of time, engineering goods as well as IT, pharma are already at an advantageous position, which we can see at this point of time. Now we have to build up, therefore, that what are the other gaps which are there as far as manufacturing is concerned, on which on electronics also, on which the reliability on China might come down or will be possibly deliberately brought down, and there India can fill in the gap.
Sure. So IT and pharma is what you're highlighting. In IT and pharma also, would it be more mid-cap ITs or large-cap IT companies that you would look at? And pharma, would you be more towards the CDMO side? Because that's also expected to start doing well in 2025.
See, as far as the large cap ITs are concerned, they certainly have much more diversified product range. So naturally, they have a larger offerings, so as to say. But at the same time, mid caps also have an advantage for they are specializing in certain very specific activities, which can also give them a benefit as well as their cost in terms of cost benefit. Also, mid caps mid cap companies are at an advantage position. So we would say that it cannot be so generic in terms of whether it would be large cap and mid cap. Both has its own unique advantage and disadvantage. So we have to see that depending upon what is the nature of the services required or indented by the US. So based on that, either of these can actually get benefited out of it. As far as the pharma is concerned, typically what we are seeing is that if I specifically go for the pharma sector, I think India would do well for the there are advantages in terms of the China Plus One and the Biosecure Act, which is coming into play. These are the things where India can possibly get an advantage, as well as where we can expect that already in the generic drugs and all, because of cost advantage that India has. I think it looks quite positive at this point of time.
Right. Mr. Banerjee, a couple of sectors that you've highlighted that you're a bit cautious on, I think, is FMCG and metal sector. So, what is your word for FMCG? Do you think the subduedness that we're seeing will continue all throughout 2025, or maybe, the second half of calendar year 2025, we could start seeing a recovery?
See, as of now, what we are seeing is that, the mood is pretty subdued as far as the consumption is concerned. We have also seen that in the FMCG sector, there are certain amount of destocking also happening. The companies, when their commentaries have also mentioned that, they are not seeing much, recoveries in terms of the sales are coming. At the same time, there's a cost pressure. Plus, there is a local competition which is happening. As a result of which, the 2025, at least the first 6 months, is certainly going to be a pain, especially in the urban side, while rural recovery seems to be happening. But thereafter, once we get to see that overall, we are expecting that the government also has, through its budget as well as other measures, has left more disposable income in the hands of the in the consumers. At the same time, the economic offtake also has happening. Then the mood will turn positive, and thereafter so H2 onwards we can see a bit of a recovery in the FMCG sectors, is what our views are.
Okay, Mr. Banerjee, thank you so much for joining in with us, giving us your views on the global as well as the domestic market, and talking to us about specific sectors that will be in focus as well. So thank you so much for joining in with us. But on that note, we're going to slip into a very short break. But after the break, we'll tell you what the banking sector can expect in Q3 FY25. So don't go anywhere.